what do you think is a rational allocation right now for somebody who's at first and foremost trying not to get destroyed this year?
Yeah, and to be clear, I don't give personal financial advice, but at a macro level, I'm happy to talk about
Absolutely. None of this is personal financial advice. Definitely talk with an advisor, and I'm going to make that plug at the end here too.
Portfolio might look like. The first thing I say, diversification, the math and the science behind diversification and why it's a good strategy is very clear. There's not much debate about that. The problem is people don't understand what diversification means. They think if they have 50 stocks in 10 sectors, semiconductors, consumer non-durables, or whatever, they're diversified. And what I say to them is, you may have 50 stocks, but that's one asset class. You're in stocks. And in stressful situations, they become highly correlated. So you're not getting the benefit of diversification. You think you are, but you're not. So what does a diversified portfolio look like? Well, I have a slice of stocks. I'm not anti-stock market, but you got to pick the sectors and the stocks that will perform well, even in the kind of conditions we're talking about. And I would go back to energy, natural resources, agriculture. So, a Marathon, ExxonMobil, Chevron, ADM, Cargill, mining companies, and not just gold, yeah, but I recently invested in a lithium mine. I think the climate alarmists, I think the Green New Deal, I call it the Green New Scam. This is a scam, but it doesn't mean it doesn't have legs, whether you like it or not. The fact is, it's going to go on. So the lithium's in short supply, graphite, et cetera. So there is a portfolio you can have, which is natural resource oriented, that will do well, even in the kind of tough environment we're talking about. Slug of cash, absolutely, maybe as much as 30%. I like treasury notes. 10-year treasury notes, but seasoned to taste. If they're a little too volatile, look at 5-year notes, 2-year notes. They're going to come down a lot, not right away, not tomorrow morning, but sooner than later, because of everything we discussed, which is a recession and interest rates will follow. They're a lagging indicator, but that'll happen. Gold, I always recommend a 10% slice.
Hey Jim, real quick before we move on from bonds there. So I've talked to a number of analysts and investors, on this program recently, who have echoed what you just said there about bonds. And there are three really good reasons to hold them right now. One is just safety, right? This is a time to prioritize safety. Two, they're paying a lot more than they used to pay. So you're getting paid to sit in safety, which is nice. But then they have that option value, right? Where if the Fed does pivot and rates come down, yields come down, the actual underlying price of the bond would go up. Right. And so a number of these guys have said, the bonds, particularly the sovereign bonds, especially the U.S. Treasuries, they're looking the best they've seen in a long while. And relatively recently, some have said it's like the best I've seen in my career. So I'm just curious, do you find that compelling for the moment in time we're in here?
Absolutely. There's hate to get too deep in the weeds in terms of bond math, but there's something called a DV01. DV01 is the dollar value of 1 basis point. What that means is, obviously basic bond math, interest rates come down, the price of the bond goes up. They're just inverted. It's a little counterintuitive, but rates come down, the bond goes up. The question is how much? And the lower the interest rate, the more the price of the bond goes up for every basis point drop in rates. So in other words, if you go from 9% to 8%, you'll have a nice capital gain on your bond. But if you go from 3% to 2%, it's still a 1% drop, but you're going to have a much bigger capital gain. In each instance, it's a 1% drop in rates, but the amount of capital gain on the bond is much higher. As the DV01 is higher when the rates are lower. Again, it's all counterintuitive.
But it's sort of like a Richter scale. Each new increment is a much higher magnitude.
The lower the rate, the greater the capital gain on each basis point drop in yields. That's the basic thing. So yeah, when you go from 3% to 2%, that's a home run in terms of capital gains. So you get the yield, you get the safety, you get the liquidity, and if you feel like selling it, you got a nice fat capital gain.
Okay, great. Thanks. Sorry to interrupt, but I just thought that was a really important point to underscore.
Yeah, I agree with the analysts who are saying that. Absolutely.
Okay, great. So on to gold, you were saying 10%-ish is
10%, but based on what we were talking about, I would get silver dollars, American Silver Eagles. The Monster Box, bit of jargon. Monster box comes from the U.S. Mint. It's Treasury green, nice shade of green. It comes with a compression strap. I recommend don't open it, unless do not break except in case of fire. But inside are 500 1-ounce American silver eagles. That's a lot. They'll feed your family for probably a year, and they run, it's a market price, but be around $10,000-$12,000 for a monster box. But to me, it's like battery and flashlights. Just have one, stick it in a safe place.
All right, great. And I'm curious, do you have any particular thoughts on silver versus gold right now in your 2023 outlook?
Yeah, I like them both. And, I talk about gold a lot because it's a form of money, and I do the monetary analysis. I do invest in gold mines, but I don't hold myself out as a geologist, but I do think about it from a monetary perspective. And then people always say, Jim, what about silver? What about silver? I'm like, look, if gold soars the way I expect, silver's along for the ride. There's not going to be a world of $3,000 gold and $20 silver. That world doesn't exist. If gold's at 3,000, silver's going to be pushing 100. So without giving an exact forecast, silver will be along for the ride. Silver is a little more difficult to analyze because it has industrial applications. Gold really doesn't. Gold's not good for anything except money, but it's the best form of money. Silver is used in a lot of applications. So if you have a recession, it's perhaps the case that the monetary value is going up, but the industrial input value is going down. So it's a little bit more of a mixed bag, but silver is going to do fine. And I do think it's extremely practical because in a world of CBDCs, silver will be a form of spending money. Gold, even the 8-gram coin I mentioned, the quarter-ounce American Gold Eagle, still $500. It's like pulling a $500 bill out of your wallet. It's a lot for groceries.
Right. So think of the gold more sort of the store of value, and silver more as the currency.
Yeah, but the quarter ounce, maybe 10 of them gets you a new car or something. So
yeah, exactly. Yeah, for bigger purchases.
Right.
Yeah. Okay, great. So that's gold. I know in the past you've said, hey, real estate, private equity, farmland, et cetera. Those are all things to consider as well.
Yeah, I think income producing real estate. I wouldn't get into commercial real estate, residential. The prices are, home prices are coming down a little more in some markets than others. But if it's income producing and it's solid and it's in a place like, someplace people want to be, like Austin or Phoenix or whatever. I mean, I know there's markets down a little bit right now, but it's like buying a 10-year bond. It's got steady monthly income and or certainly farmland. But income producing real estate, not commercial office buildings, should be a part of a diversified portfolio. Yes. All right,
great. I got one last topic I want to talk about with you. Before I do, anything else just sort of on, actually, let me ask this. So we talked there about sort of diversification, largely with the eye towards sort of making it through what's coming here. Are there any areas that you potentially think are like, hey, given the events that we see coming, yes, while they're a little scary, there's some opportunity maybe to really, if you have some speculative capital, this could be a place that you think could pop really well?
Yeah, I mean, I like private equity, and it's, you got accredited investor issues and finding good deals and good promoters and good management. But there's some some good deals in the mining sector. I like, well, that would be one. I mean, we haven't really talked about the important things going on, but we'll maybe do that in another interview.